Good afternoon to you learners from the Northern Cape, and welcome to this, our 8th session of Business Studies Revision. And I believe there are learners of the Western Cape, of Overberg and of the West Coast also joining us. Please let us know where you tune in. The SMS number is 31498, 31498. I trust you had a blessed afternoon. I want you to be relaxed, and I trust that you're ready to enjoy this presentation that we are going to offer today. Before we start, however, I would like to introduce my co-presenter, Amanda Juries. Amanda, I'm sure the learners of the Northern Cape and West Coast and Overberg don't need to wonder about the weather in Cape Town today.
Good afternoon, Leicester, from a cold, rainy Stellenbosch, I must say. Over to you.
Yeah, Amanda, we spoke earlier about the number of days that are left before they write their final examination. Can you just remind the learners once again?
Learners' time is running up. We are writing CAT on the 8th of October, which means 21 school days. And the English is on the 22nd of October, which gives us 35 school days.
Right, we've got a walking, talking examination timetable here in front of us. Thank you for that. Learners, let's go to the first slide. You will recall session 1 to session 7 covered topics in learning outcome 1 and learning outcome 2. We started with investment opportunities. We would like to start today with session number 8, and we're going to continue with learning outcome number 2. In particular, we're going to look at insurance. Yes, we're going to look at insurance, and I'm sure you'll recognize some of these logos of the insurance companies, and we'll talk more to that later on. Again, a reminder, you may not have a copy of this presentation. If you would like to have a copy of this presentation and also the previous ones, my email address is ldmomberg@gmail.com, ldmomberg@gmail.com. We will give it again during the course of this presentation. Educators, please note, you can also access these PowerPoints on the Moodle website of your education district. Right, so what are we going to look at in session number 8? Firstly, we're going to look at some concepts relating to insurance. Now, it's important, if you want to understand the subject, you need to know the language and the terminology. And so we're going to look at some of the concepts that are very important. We're going to look at the principles of insurance, look at the spelling, PLES, the principles of insurance, the importance of insurance. Then we're going to look at different types of insurance. We are going to look at the difference between assurance and insurance, the difference between assurance and insurance, then the requirements of a valid contract. We are going to look at insurable and non-insurable risk, and then also we're going to look at compulsory insurance. In addition to that, we're going to have some consolidation questions, and Amanda, please remind me later on, 5 minutes I want to spend on some essays. And so, learners, those are the things that we are going to look at today. I see that we've got Rietvale High looks forward to this session. Paulus and Rosina is tuning. There's a good day from Creswell High. Creswell, it's good to see you. Know that you are also tuning this afternoon. And then there's a visitor from Creswell also saying good afternoon, and they're looking forward to the sessions. Learners, please let us know where you are tuning so that we can acknowledge your presence. Please also, the SMS number 31498. We are going to ask you some questions later on. Amanda, could you start with the insurance and in particular the description? The learners need to know what is the meaning of insurance.
Your insurance, number 1, is a written contract. And that contract is between your insurer and your insured. And just here we need to stop so that you can know the difference between the two. Your insurer is the individual that is asking to be insured, and the insured is the insurance company.
I think, Amanda, we just need to go back to that quickly.
Okay.
The insurer, that is the insurance company, and the insured, that is the individual or the individual business that wants to be insured.
Okay.
Learners, these concepts we are going to come across quite a lot during the course of this presentation, so please make sure you know the difference between the insurer, the company, and the insured, the person or the individual. Amanda, continue.
Okay, so the insurance company, that's your insurer, they undertake to compensate the insured, and the insured will undertake to pay your monthly premiums. And the whole reason that we have an insurance contract is to shift the risk, and we call this the concept of indemnity. So you indemnify yourself against any risk taking place, and that is why you choose as the insured to pay the insurer a monthly premium. Right, Leicester?
Thank you, Amanda. Amanda, you've mentioned quite a few concepts that learners need to know. They need to familiarize themselves with the concepts. In particular, learner, these are some of the concepts that appeared in the definition of insurance, but that you in particular must know the meaning of. The insurer, the insured. What does it mean when we talk about security in terms of insurance? The market value of a product. Indemnification. Look at the spelling. Indemnification. What is a clause in a contract? Subrogation. Now, I'm sure you've heard about this concept already. We are going to revise it just to consolidate your knowledge. The difference between the market value and the book value of an article or product. A premium. Average clause. Reinstatement. Good faith. Cession. Reinsurance. Iron safe clause, and insurable interest. Now, learners, we will not have an opportunity to go through all these concepts. We're going to look at a few of them. It's your responsibility to please make sure that you do look up the meaning of the others and study them thoroughly in order for you to understand the concept of insurance. Right, reminder, the first one we're going to look at is utmost good faith. Could you explain to the learners what that means?
Okay, when it comes to utmost good faith, the insured has to be honest. You have to disclose all information when entering the business contract. So, for example, if you're taking out an insurance policy with clientele, you need to disclose you have high blood pressure, you have diabetes. Otherwise, they will not pay out your claim. Your details must be accurate. And if you do not adhere to this, your insurance contract becomes null and void. If the insurance company find out afterwards that you weren't honest, they can refuse to pay your claim.
Amanda, this concept of utmost good faith, it applies to both the insured and the insurer?
Oh, absolutely. The insurance company, you know, when they give you, when you sign in your contract, there's a lot of small print, and it's your duty to go over that small print, but they also need to be upfront and honest with you. As it's your duty to be honest, it works both ways.
Okay, good. The concept, yes, utmost good faith. I'm not sure if you read in the newspaper about a month ago about a mother who took out insurance on the lives of her 3 sons. And then she hired a hitman to kill the one son because she wanted to claim the money on his life. Now, certainly that would not be good faith.
No, it will not be good faith, but what a person tend to forget that the insurance companies, before they pay out any claim, they have their own investigators and they will investigate. And if there's any foul play, if they can pinpoint that she hired that hitman, she will not get a cent.
Absolutely. Amanda, look at the next one. Insurable interest. What does that refer to?
Your insurable interest, a person can only insure an asset and claim if they are going to suffer a financial loss when an event occurs. You must be able to show the insurance company that you have insurable interest in something. Like on this slide, you can see you can insure your own life, your own assets. I can say if someone steals my cell phone, I will be in the worst financial position. So I have insurable interest in that. But I can't insure your car because I have no insurable interest if your car goes missing or not.
But what about if I'm unemployed and I don't have an income? Will you be able to insure my car?
No, because I don't have insurable interest in it. It doesn't make a difference to me. My life, I can't claim that will make a difference if anything happened to your car. It will inconvenience you, but
So if you do insure my car, it will be considered to be a loan.
No, it will consider to be unethical.
Oh.
Don't you think so?
If you say so, then certainly it will be. You say a married woman has insurable interest in her husband. Now please explain that.
You know, this is one of those strange things. A married woman has insurable interest in her husband, but her husband does not have insurable interest in his wife. I mean, I think this comes from the concept where in most cases the man was the breadwinner in the home. So if anything happens to your husband, there's like no money, or you know, things will be, you'll be in a tight spot. But if something happens to the wife, we assume that the man will go on.
Yeah, I'm sure in the 21st century that I can take out insurance on the life of my wife, especially if she's earning more than what I'm earning.
I'm sure, but unfortunately this hasn't been changed yet as far as I know. But it could also be regarded as discriminatory.
Absolutely.
Okay, the next one is you have insurable interest in your business partner.
Can you just explain that?
Yeah, I was going to. This one is actually a big one. You must remember you and your partner is responsible for the business. And you need to take out insurance on him, because if anything happens, you will have a cash flow problem. Because it takes sometimes up to 2 to 3 years to, just to tie up the estate and that. So if we don't want a situation where you're going bankrupt, and that is the reason why you take out insurance on your business partner. And this is one of those things that needs to be covered in your partnership agreement.
Okay, I think, yeah, we're going to come back to that one, taking out insurance on your business partner.
Okay.
It's called the buying and selling insurance, but we'll come back to that one later on. Amanda, you say a debtor has an insurable interest in the creditor, or is the creditor having insurable interest in the debtor?
I think it's probably the creditor having insurable interest in your debtors in case your debtor don't pay. Because you probably want a situation where you don't have too many bad debts.
Just tell me, why did you look so funny at me when you said, especially if you don't pay?
Especially if you don't pay. But another one, I'm not sure if it's on the slide, it's also like when you take out a mortgage loan at the bank. Your bank also has insurable interest in you. So in case anything happens, and then they know that they will get their money back. So if we borrow money to our debtor, we need to know at the end of the day, no matter what happens to the debtor, we will get our money back.
I think, yes, if we lend money to the debtor, remember the debtor borrows money from us, so we will lend to the debtor.
That's right.
Right, let's see the next one. Indemnity, we had it earlier. What does that mean?
Okay, your indemnity principle is the insurance will put you in the same financial position you were before the event took place. I think, Leicester, there should be a slide over there, the next one. Here, guys, if your Lumnia 610 was stolen, and it was stolen, and you have a case number from the police because they are going to investigate this, the insurance will not give you the Lumnia 9200. You will get the same Lumnia 6010 back because they are going to put you in the same financial position that you were. The insurance company is not out to make your life, to improve your lifestyle. They will be there to make money, so they are not going to enrich you. You however have the option of paying in extra money if you want the 9200 probably.
Amanda, can you just tell the learners about that instance when you insured your horse? What happened there?
It wasn't me that insured my horse, Leicester. That was the outsurance advert that they used to have on TV. Something happens, the guy comes and he puts in the claim for outsurance. And then they come into the stable, and as they open up the stable gates, it's like he looks down and he sees the pony and he says, "But this isn't what he was expected." And then the insurance guy says to him, "But this is what you've paid for." And I mean, that comes the case of underinsurance and also of indemnification. They will not enrich you. What you pay for, that is what you're going to get at the end of the day.
Okay, so another example could be when I insure, for example, a Uno for 10,000.
You will not get a Bentley.
Okay, that explains it. Thank you for clarifying that.
You will not get the Bentley, you will get the little Uno back.
I was just about to ask somebody to organize a hit on my Uno, but I'll refrain from doing that. Amanda, the next one, average clause. Now, this is an important principle that is used in the insurance industry. Just explain to the learners quickly, what does this really mean?
Your average clause is very important. I have not seen a question paper that do not have this question in. From the old syllabus to now, it's always been in. So your average clause is the payment of the insurance claim will be according to the value insured. If you are insured for full value, then you will be paid a full claim. If you are ever underinsured, and that underinsured would obviously mean you're not, the full value of the asset is not insured, then they will only pay out that proportion that is insured. For example, Leicester, if we have property, and our property is worth R1 million.
Okay, Amanda, let me just write it down quickly. You say we've got property and it's worth R1 million.
Okay.
Righto. Learners, when you write the total in rands, please always remember to put the R in front, and if it's going to be cents, put the cents at the back.
Okay.
Righto. So what's going to happen?
Say, for example, we have property for R1 million. But, we find that, our budget is just not making it, and we only take out insurance for 600,000 rand.
Righto. So we're insuring it for 600,000. That is our insurance. Alright, talk to me.
That means
So if there is damage to the building, say we have a fire, and the damage is calculated to be, say, 100,000. $1 million question is, will the insurance company pay out the 100,000 rand damage?
Absolutely not. Maybe this is a good opportunity to ask the learners out there what percentage the insurance company will pay.
Or what amount will the insurance company pay?
Even better. So
learners, let's see quickly. Crestway and Rietvale High learners. Wow, you heard earlier Amanda saying that this question is often asked in examination questions. If you didn't write in September yet, expect it to be in the September paper and the end of the year. Will you be able to calculate what amount will the insurance company pay out, considering the fact that you've underinsured? Let's see quickly, Amanda, we can...
Maybe give them the formula.
The formula is quite simple, Amanda. Firstly, we're going to say the underinsurance formula. Underinsurance would be firstly the value that you insured the property or the asset times the damage divide by the market value of the property or the asset. Learners, that is the formula to calculate the amount that the insurance will pay out using the average clause. I wonder if you could give us the answer. Anybody? Amanda, we can give them about 10 seconds.
Okay.
Come, Rietvale. You've got the formula in front of you.
Leicester, often when this question is asked normally in a twofold way. Question 1 is they will sketch the scenario to you what's happening, and question 2 is they will always ask what clause is this.
And a third question they can ask is what amount will you be responsible for of that damage?
True.
So there's actually 3 questions that they can ask.
And normally
right, Crestway says they don't understand the question. Crestway, what's happening here? We've bought the property for 1 million rand. We've insured it for 600,000 rand. The value is $1 million, but we've insured it for 600,000 rand. You will recall from the content that was dealt with in term 2 that this process is referred to as underinsurance. So we want to calculate the amount that the insurance company will pay out if you put in a claim for 100,000. And we've got an answer there from Rietvale. They say the insurance company will pay out 60,000 rand. And Rietvale, you are 100% right. Let's just look at the calculator and put that formula, use that formula to calculate the amount that the insurance company will pay out. Firstly, we say the value insured was 600,000. And then the formula says we must multiply it by the damage, which is 100,000. And then the formula says we must divide it by the market value of the property, which is R1,000,000. And the total the insurance company will pay out is 60,000 rand. Litwell, congratulations. And obviously the other question they can ask, for which amount will the business be responsible of the damage? And the business will be responsible for 100,000 minus the 60,000 that the insurance company will pay out. So the business will be responsible for 40,000.
And this is an example of the average clause.
And this is an example of the average clause principle being used.
Okay, I just see there's an SMS in from Lotus River. And it's good afternoon, Lotus River. It's the first time in one of our sessions that we receive an SMS from you. So welcome.
Yes, now Lotus River, yeah, your SMS didn't come through. I was looking forward to getting the SMS, but it didn't come through. It only came through 10 seconds ago. So we would like to welcome you, those grade 12 learners I spoke to on Friday. I trust that all of you are sitting there and that you are ready, also participating. And please, yes, let us know who's in the classroom there with you. If your educator or the principal is with you, please let us know. Amanda, we need to continue.
Oh, absolutely.
Excess. Please talk to me about excess.
Okay, excess. Oh, this is a very sensitive topic to many people that are that have insurance policies.
I don't understand, you take out insurance and then because insurance is like a necessary evil.
Oh, yeah.
You agree? And then they come with something like an excess. Please explain to the learners quickly.
It's the smallest amount you need to pay in before you can claim. Let me just tell you, Leicester, the idea around excess is some people claim for everything. If I have insurance on my car and my car's little, the rear view mirror breaks, then I want to claim the money from the insurance. So the insurance don't want me to hassle them with all the small little things. So what happens, they say, if your excess is normally 5,000 rand. So if something big happens, say like the car gets stolen, for example, then I know I must pay whatever the amount of the car is, less the 5,000 rand I pay, and then they will cover the rest. So it's to prevent people from claiming for small, non-essential little things.
Yeah, no, okay, I can see I think you've got some shares in the insurance company because you're really promoting them. But I think it's just another way of them getting more money out of the insurer.
But I think it's also a way of controlling your premiums. Otherwise, your premiums will become too high. If you claim if you're claiming for everything, every time you claim, your premium becomes higher. Which also means if you're not claiming, your premiums will become lower.
You are defending the insurance companies like never before. I think you've got an insurable interest in some of the insurance companies. Lotus says that Mr. Sampson is with him. Mr. Sampson, we are really thankful that you are sacrificing the afternoon to be with your learners. Right, Amanda, so let's give us an example quickly.
There we go. I got my Kia Rio gets stolen.
Was it insured firstly?
Oh, absolutely.
Which company?
Budget.
That explains.
The car has a market value of 155,000.
A Kia Rio, 150,000?
Yes. These are Korean cars, you should know. They come up value for money. The excess is 5,000 rand. That's the portion I must pay in first. How much money will budget insurance pay me out? And there you go. It's the market value minus the excess. So 155,000 minus the 5,000. So I will get 150,000 rand from budget, and that will put me in the financial position to buy me another Kia Rio.
Okay, and then in addition to that 5,000 that you must pay, if the market value of the new Kia is say 150,000, 55,000, you still got to pay an extra 5,000.
Yes, but it's better than being in a situation where I have no insurance at all and I don't have the cash money. If the car isn't insured, Leicester, and something happens and the car gets stolen, I'll be in no financial position to buy a new car. So that is why we have that unnecessary evil of paying insurance.
Which evil would you prefer, paying insurance or paying tax?
I have, you know what the Bible says, pay Caesar what Caesar is due.
Amanda, we see that Miss Demas of Crestway, a very school that regularly tunes in She's also watching with her learners, Ms. Demas. Thank you for the sacrifice. And then also KS Shipping. The high learners are also enjoying the lessons. We are watching with our teachers. It's just amazing to see and gratifying to see how many educators are really sacrificing their Sunday afternoons to be with their learners. And learners, I hope that you are using this time to show your educators again that you are serious about your studies and put a smile on their faces also. Amanda, let's continue quickly. Subrogation. Oh, big word. Subrogation. Please explain to the learners what that means.
The insurance tries to get the money back from the guilty party. Listen to this example. Another motorist smashed into Leicester's stationary car, and the driver of the other car was texting while driving. Leicester's insurance company will pay his damages, but afterwards they will claim the money from that driver that was guilty in the first place.
Just hang on. The insurance company will claim the money that they paid to the insurer back from the guilty party.
That's exactly it. You must remember, you've insured your car. So the insurance company must honor their commitment to you and pay for your car's damages. But they realized that you were not the guilty party. The person that was texting while they were driving, they are actually guilty. So they need to get the money that they paid you back from them. You must remember, the insurance companies are there to make money. That's the only reason why they are so big.
So they are, the insurance company, they never loses.
Oh no, absolutely not.
They smile all the way to the bank.
Okay, just one question. Have you ever heard of insurance company going bankrupt?
Not yet.
I rest my case.
Except in Zimbabwe. But that's another story.
For another day.
Amanda,
okay.
before we continue, good stuff from Faith and Ingrid and Natabeling and our teacher, Mr. Nakatu. Welcome to you people, and thank you for joining us. Hello, grade 12B from Castlesvlei Secondary High School.
Wow.
We'd like to say that we are enjoying the class today. Just please say hello to Miss Seko from Dean. Miss Seko, a warm welcome. Hello, and thank you for sacrificing your afternoon. Your learners, I can see they really appreciate you. We really thank you for being with them this afternoon. Aisha, Dree, Pimper, them and Da. Whoa, all of them. I don't know which school, but welcome to you also. Right, subrogation. Amanda, thank you for that. Reinsurance. Re means again. Insurance. Please explain.
Okay, it's when the insurance company cannot carry the risk by themselves, as it's either too big or too risky. Therefore, they choose to share it with other insurance companies. On the screen there, you have a picture of the QE2. Now, the market value of that boat is about 4,500 million rand. So you can see, Leicester, it's almost impossible for one insurance company to carry that amount of risk. Because if anything should happen to that ship, and I mean, there are just so many risks. There's fire, they can hit an iceberg or whatever. So what they do, a couple insurance companies come together and each one will insure a different risk for that boat.
For a minute, I thought you were going to say they can hit a Momberg instead of an iceberg.
Possibly, you never know.
But Amanda, so what really happens is that you've got quite a few insurance companies
that are sharing the risk.
That shares the risk. So the premium that's paid gets paid, it's proportioned, and it gets paid to the different insurance companies.
Yes.
So when there is a claim, they will then pay proportionally the value of the amount that the ship was insured for. Is that how it works?
Exactly, Leicester.
Great stuff. Amanda, the learners are joining us fast and furious. Piscodia High, they say they're also watching, and again with the educator, Ms. Olifant. Ms. Olifant, good afternoon to you and welcome. Thank you for joining your learners today.
And Leicester, it's so nice on this cold winter's afternoon. I just think these teachers could have been at home enjoying an afternoon snooze, and yet they choose to be with their learners.
I think two things is happening, Amanda. Either their learners must still write and they know that their learners will benefit from these sessions, or they are preparing their learners for the end of the year. So anyway, in either case, we still appreciate the fact that you are with us today, educators and learners. Right, Amanda, let's see the next one. The next one we're going to look at learners. We've covered some of the concepts. I told you we won't be able to cover all the concepts. Please go look through your notes, look at the explanations given in your notes and also in your textbooks to find out the meaning of those concepts. Principles of insurance. there are two principles of insurance that you need to be familiar with. The first one is indemnification. Amanda dealt with that one earlier, so please study that in conjunction with this principle. And then the principle of security. Amanda, we didn't cover security, but security simply means that there is security for the person who retires, that when he retires, he will get a monthly income. But there's also security for the family of a breadwinner if he should die, that there will be an income for them also, if a life insurance policy was taken out on his life.
Yes, later on we will also cover security when we do assurance and insurance.
Okay, good. Right, learners, so two principles, indemnification and security. You've got to provide explanations on that. Right, very important. Why is insurance important? And if important, you've got to know it's important both for the business and also for the individual. Let's first look at the importance of insurance for the business. The business can insure against theft and fire cover. The business can also take out what we call product liability insurance, and that is in the case of a product that could perhaps be defective, that was manufactured and there were errors. For example, if I've got a cell phone and that cell phone explodes in my hand, then I will certainly have a claim against the manufacturer of those cell phones, and for that reason they will take out what we call product liability insurance. We had a case 2-3 years ago when the Honda car.
Honda Jazz.
The Honda Jazz. What happened there? Was it one of your cars?
The Honda Jazz, I know. I think it was something to do with the car's immobilizer system, if I'm not mistaken.
So what happened to while the person was driving?
No, I'm not, you're catching me unaware with the scenario, but as I can think back what happened, the lady went shopping. So what she did, she came home, she took the groceries inside and she left the child in the back of the car, and suddenly the car exploded and they realized there was something wrong with the immobilizing system of the car. It was an unfortunate incident, but what happened is Honda recalled all their cars from the market to make sure what was the problem, discovering there was a problem with the immobilizer system. I don't know the technical details, but it was a very sad.
Now, okay, I'll send you a technical report later on. But the type of insurance that was taken out was product liability insurance. Okay, the next one is called employer's liability insurance. Now, learners, you must remember this is not for the employer. It's taken out by the employer in case there are employees who get injured on duty. And Amanda, we're talking here about the Workmen's Compensation Act.
Yes, this is now very important. We will cover this later when we do compulsory insurance, but this is one of the big insurance policies that, this is compulsory. Employers don't have a choice but to take this out. And as Leicester said, it covers the employees against any injury while being
on duty. Then the buy and sell insurance. Now we spoke about that earlier, where there are co-owners and they take insurance out on their lives or their partners. Example would be, we've got these three gentlemen and ladies that's got a business. They are all partners. The value of the business is 3 million. Right, so we've got 3 people. Value of their business is 3 million. Right, so what happens? On one sad day, one of the partners, he dies. And so now there are only 2 left. And so they are sitting with a problem now. They've got to pay out this partner's value in the business, and that is 1 million. So they need 1 million. Now you don't just get 1 million overnight. So what they do, they invest or they insure the lives of all 3 partners. So in the event of one dying, the insurance company will pay out the money, and then they can pay that money out to that person's deceased estate.
And also they can pay that money into the business as well if it needs to be. Cash flow problems and that.
Absolutely. If they insured it for more than the value of the
million rand,
then that can be plowed back into the business.
Leicester, so you have SMS there.
Yes, Amanda, we are going to look at that one now. Just the importance of insurance for the individual. Again, theft and burglary, motor vehicle accidents, retirement, deaths in the event of death, and losses due to unemployment. Amanda, types of insurance, there are basically 3 types. Just talk to the learners about the 3 types quickly.
Okay, Leicester, there is short-term insurance, long-term insurance, and compulsory insurance. So short-term insurance is going to be, it's not compulsory, it's voluntary. These are the insurance like when you take out insurance against motor vehicle, there's theft, there's burglary, storm damage as well. In business, it will also be cash in transit insurance, there's fidelity insurance. And I see you mentioned there your multi-peril policies as well. Yeah,
that is important. The multi means a few. Peril means what could possibly happen, risk, and policies. And what that simply means is that a number of covers are being combined in one policy.
Okay.
So you've got fire, storms, floods, riots, strikes, theft, malicious damage to property, all covered in one policy. We call it a multi-peril policy.
And this type of insurance is to get that peace of mind.
Amanda, you alluded to these types of insurance already?
Okay, yes.
Again, that multi-peril policy can also be taken out by the farmer. So you've got hailstorms, you've got excessive storms, and you've got drought. And so you can put all that into one policy. We call it a multi-peril policy.
Okay, then the next one you're going to have is your long-term insurance. Here we're looking either at life insurance or we're looking at retirement annuities, as well as, saving for your pension fund. And then this is the most important one, grade 12, is your compulsory insurance. We have 3 compulsory insurance that every business must take out. You're going to have number 1, it's your unemployment insurance fund. Number 2, your road accident fund. And then thirdly is going to be your compensation for occupational injury disease act. We call it the workmen's compensation as well. And
okay, Amanda, so that's briefly the 3 types of compulsory insurance, UIF, RAF, and COIDA, and we're going to look at each one of them separately later on.
Okay.
For now, however, we need to know what is the difference between insurance and assurance.
Okay. Leicester, there's insurance and there's assurance. We talk about in life the possibility of 2 events happening. There is something that's a definite event and there's something that's a possibility. So your assurance covers your definite event. The only definite thing in life is death. So that will happen. Where insurance is something that could possibly happen. So for example, the bio insurance is going to be like a fire, a theft. Your house may burn down. It may also never burn down. But the insurance company will pay out if it does happen. If it does not happen, they will never pay out. You're just paying for that peace of mind.
So with insurance, they will only pay out if you put in a claim.
And if the event did take place.
If that event happened and you put in a claim. However, with assurance, there will always be a payment when the event happens.
When a family person dies, the next of kin or the family will then get the money for the life insurance policy.
But also the retirement annuity fund is when the person, the insurer, reaches a certain age, or the insured rather, reaches a certain age, example 55. Then they will pay him a pension for the rest of his life.
Guaranteed.
Guaranteed. Amanda, time is really running out. We've got one question. We'd like to thank our educator, Ms. Mudlovu and Mr. Sahiri. We are here with us in Petrusville High. Rita asks, what happens if one partner takes money for personal usage and the business suffers a big loss? Theft. Company can take out insurance for theft of money?
The theft is normally, you know, when there's an outside party, but you can't, I know, like the insurance covers fidelity insurance, that's against an employee. But the insurance company doesn't cover theft against one partner against another partner.
Okay, that answers that question. Cresway, hi, we're glad you are with us again. They said they had a network lost connection, but they are with us again. Amanda, requirements of insurance contract, two things. You spoke about it already, good faith and insurable interest.
Yes.
Right. The difference between an insurable risk and a non-insurable risk. Can you just talk to that quickly? An insurable risk, very briefly.
Insured must derive a financial benefit from the existence of the object which is insured. We spoke about this earlier when we spoke about insurable risk. Like I have insurable risk in my own life. The married woman in her husband. That is basically it.
Okay, and then non-insurable risk.
A non-insurable risk is a risk for which no insurance can be written or something that the insurance will not cover at all. Say for example, you know, if a company has a clothing line and the clothing line don't sell, there is no way the insurance cover is going to cover for that.
Amanda, quickly, my son is in grade 12. Can I take out insurance on the fact that he's going to pass his matric at the end of the year? If he doesn't pass, I'll still get a certificate for him.
Oh, that's a non-insurable risk.
Okay, thank you for clarifying that. Again, Amanda, you alluded earlier to the three types of compulsory insurance.
Like it was unemployment insurance fund, road accident fund, and your workman's compensation. And grade 12, this is always ask one of the three.
Great stuff. Amanda, if we could just look at, you've got some consolidation questions, learners. These questions will be on the PowerPoint. Educators, please note, you may be, send me an email and I will gladly forward the PowerPoint to you with the consolidation questions and also the answers. Learners, time has unfortunately run out. I'm not sure about you, Amanda, but I was certainly enjoying this session. But it seems to me time just flew. This is, however, our last session for this term. If you are still writing your trial exams, I trust that you are thoroughly prepared and that these sessions will certainly help you. Please get hold of a copy of the PowerPoints. Email me at ldmomberg@gmail.com and I will gladly email all the PowerPoints that we had for the past 7 sessions. I really want to thank you, Amanda, for really entertaining us this afternoon and for sharing your knowledge with the learners. Just a final word of wisdom.
Oh, grade 12s, I'm just so pleased to see so many schools here today, and to so many schools it's been SMSing us. It's been absolutely fabulous, because sitting here in the studio we never have an idea how much people are tuned in. So that is great. And grade 12s, I'm also glad to see the passion that you have for the excitement, the passion you have for the subject. I'm glad that you're working hard. We're looking forward to having good results in the Northern Cape and in the Western Cape.
Amanda, thank you. Then also don't forget the educators that were present. We really want to thank you. Learners and educators, goodbye from us and enjoy the rest of the afternoon. We are seeing you again in October. I think the 14th, we're seeing you again, and we trust that you will join us again with your friends and your educators. Good afternoon and goodbye.
Bye.